All right, guys, we are here. We got the FOMC meeting going live very, very, very soon. Very, very, very soon. And yeah, it is time for the FOMC stream today. Big news. Huge day for finance. Everybody's going to be tuning into this. And yeah, watch it here at the Beginner Trading channel. It's almost certain that we are going to pause interest rates today. So if you are betting on a rate cut, I don't mean to say this, but you're wrong. We're not going to cut rates today. That's wildly unexpected, like 99 to 1 or less probabilities of that not happening. It's pretty freaking probable we are going to pause interest rates. And so the attention is always in this situation whenever it's not super split, when it's super one-sided in terms of decision probabilities, the attention always goes to what Big Papa Jerome Powell says during the FOMC press conference. What is this tone like? What color is this tie? It's going to be purple probably. And what is his tone like? Is he going to be hawkish, restrictive? Hawkish meaning he wants higher interest rates. He wants to combat inflation through restricting economic growth, through higher interest rates. And the opposite of that would be dovish, loose, less restrictive Powell, where he wants to stimulate the economy because of fears of economic weakness. My guess here is going to be data dependent. He's going to be pretty split right down the middle. He's not going to be super one-sided. I think he's going to be really apprehensive to give guidance here. I think he's going to say case by case, data dependent, 2% inflation goal, dual mandate of strong labor market with low inflation. And again, we'll see if that happens. I think he's going to be pretty split down the middle. With that said, though, we're going to do a poll. Will Jerome Powell have a hawkish or dovish tone during today's FOMC? Hawkish or dovish tone during today's FOMC? We'll see, guys. We got a hawkish option right here. We're going to put this option on the poll right now. We got a dovish option right here. We're going to put this option on the poll right now. And I want you guys to vote on this poll immediately as soon as we post it. It's live right now. Oh, wait. That's another hawk. I got two hawks. Wait. Copy. All right, guys. Whew. You know which band is really good that nobody gives enough credit? I used to listen to them a lot when I was younger. I'm showing my daughter them now. The Offspring, Americana. Great album. Great freaking album. You know, childhood in an album. So here's the poll. Oh, wait. No, I messed the poll up, guys. Oh, man, I got to end this and redo it. Great. Yeah, really interesting day. Pretty probable that Jerome Powell is going to be... pretty probable that Jerome Powell is going to pause rates. I genuinely doubt he's going to influence or change interest rates in any way whatsoever. Pretty probable. Again, let me know in chat right now. We're going to get the poll up live. Where's my hawk emoji? All right, now we finally got the poll right. Split that. We did a poll on x.com as well. Hawkish, dovish tone during today's FOMC. I got to proofread it this time to make sure I get it right because I messed it up last time. Hi from Germany. What's up, Julio? Is it Julius? What does pausing rate mean, good or bad? So, okay, let's give an economic rundown real quick. Let me, is that your Ray-Bans you got on? No, these are not Ray-Bans. These are, I think these are Sperry's. Like, the irony of my glasses is hilarious because if I get on a freaking cruise ship, I get seasick. But for some reason, I got Sperry, which is like boats, like boat glasses. I've got boat glasses. Like boat brand glasses. Like, you know how you can have like Nike glasses? These are Sperry's, which are boat shoes. I don't care what the logo is. I just like the way they look. So don't judge me with these glasses on. And yeah, we are here. Let me get some actual music playing. What happened to creator music on YouTube? Let's get some music playing here. I'm going to put my old playlist up. Actually, you know what? I'm going to put Moods. We're going to put suspenseful songs. Instrumentals. There we go. Let me know if the sound is loud enough. Let me know if that's loud enough. Should be pretty good. All right, looking at our poll, we got 50-50 split. Hawk dovish. Okay, so let's talk about economics here for a second. All right, everybody here, if you want to understand what this Fed meeting means in a really quick, easy to understand way, listen to what I'm about to say. The Federal Reserve, which is independent of the government. This is like the bank that polices and creates policies for other banks. So you got the Federal Reserve, which is like the head bank, and then you got a bunch of regional banks, and you got different heads of those regional banks. That's why you'll hear like Atlanta Fed president. That's the Atlanta Bank. Now, the Federal Reserve creates policies and influences other banks as well as the U.S. economy through those banks. And what they do is they influence interest rates as one of their big tools. Now, the Federal Reserve does not always want a thriving labor market. You might think interest rates being low is always good, right? And to a certain extent it is if you want to get a loan out. But too strong of a labor market and too much economic stimulus can cause inflation problems. And inflation in the Fed's mind is just as big of a risk as a recession or depression is, which is the opposite of inflation in a lot of ways. So the Federal Reserve controls what's called the federal funds rate. These are short-term interest rates that eventually trickle into long-term rates, right? Directly, they influence adjustable rate loans, home equity lines of credit. These are the rates that are adjusted in adjustable rate loans is the federal funds rate, the short-term interest rates that we get. And again, the Fed does this depending on what the big problem is in the economy. If the economy is too strong and we have inflation problems, the Federal Reserve will be restrictive. They will raise interest rates, which is called a rate hike. They will also take liquidity away from the bonds and finance markets by doing something called quantitative tightening. On the other end of that, if the economy is in a bad shape, if we've got weakening GDP data, high unemployment, low payroll numbers, and ultimately we're heading towards a recession or depression or in a recession or depression, the Federal Reserve can play the other end of that, and they can stimulate the economy through low interest rates. And the logic of it is that when interest rates are low, people tend to spend less. Or when interest rates are low, people tend to take out more loans, and that in turn makes retail spend more, but also businesses take out more loans and expand. And thus it stimulates the economy because then businesses can then hire people, and we get economic expansion and stimulus through low interest rate environment. Now, the Fed can also do a more desperate measure besides just straight up lowering the federal funds rate. The Fed can also do quantitative tightening, QE, quantitative easing, which quantitative easing, QE, is basically the Fed printing money by creating online money and then using that online money to buy up a bunch of bonds and other financial assets. This injects liquidity into the economy and also helps bring interest rates down through influencing bond prices and liquidity. An example of this is 2020. They also did this in 2008, or the mortgage disaster in the mid-2000s, where they stepped in. They brought interest rates down to almost zero in 2020. They also did QE. They injected liquidity into the economy. They also sent out stimulus checks. These are all different types of economic stimulus that they did in 2020. And it helped the market rebound a little bit faster. But because the QE, because the low interest rate environment, because the supply chain problems of 2020, as well as the QE, lower interest rate, supply chain problems, as well as the stimulus checks, all four things contributed to massive inflation spikes by 2020 or by 2022. So by 2022, inflation, depending on which metric you look at, was way up from the average of 2 to 3% all the way up to 5, 6, 7, 8% by 2022. And so that in that situation, the Federal Reserve says, okay, the labor market's strong, but we have inflation. Let's be restrictive now. And so then you can look, like if we take a look at the actual graph by the Federal Reserve, you can take a look at the actual graph here. If you take a look at the graph over the last 5 years, they brought interest rates down to almost zero in 2020. You can see the interest rates being super low. And then by 2022, when inflation spiked, they raised the federal funds rate to over 5%. And then they paused it for like a year straight. They didn't start cutting rates back down until late last year in September. In September, they cut rates 50 basis points, and then they cut rates another 25 and 25 in November and December. And then they've been pausing rates since December, right? And so this is the federal funds rate. And so now we're still kind of elevated in interest rates. A lot of people would consider interest rates to be still very high to this day, but because of inflation fears, because again, inflation has gone up so much. Inflation doesn't go back down. It slows down. The only time it goes down is if we actually enter a recession or depression. And so a lot of people right now are paying 2, 3, 4x what they were in 2019. And so the Fed fears inflation because that makes the public unhappy as well. If they didn't fear inflation, this rate would already be much lower. But because inflation is still an issue, they're pausing rates, and they have been for the last few meetings. And today they're expecting a pause again. So this rate is expected to go like this after today. It's not expected to go up or down any today. The next time they're expecting a rate cut is in July as of now. And again, this is on the heels of the tariff news, the presidential pressure for rate cuts, and all the stuff going on. But again, as of now, the Federal Reserve has not changed interest rates over the last couple months. They've been pausing rates. And again, it's pretty probable that we're going to pause rates today, 99-1. And so whenever something's that one-sided, all the eyes and attention are going to pivot to what Big Papa Jerome Powell says during the FOMC conference, which again, we are going to stream it completely live right here as it happens. We're going to cover the full statement from the Fed at 2 p.m. as well as their rate decision, which again, cough, cough, is going to be a pause. I have a bet with my subscribers that if we do not pause today, I can only respond to dummy over the next week. All right, that's the bet I have with my subscribers. And so we'll see what happens. But yeah, somebody says, hey, you say the same thing every day. I say it every day so people understand what's going on. The people that tune into this meeting are different people than my morning streams. My job is to help people understand economics, and so I guess the point is, of course, I'm going to say the same thing because people asked me to say it this time, All right, just an interesting question. Who in here thinks we're going to cut rates today? Anybody here think we're actually going to cut rates today? Genuinely curious. Again, listen, if we do cut rates, I will eat my words. I will make fun of myself so much if we do. Taking a look at gold. Taking a look at the NASDAQ here. We got the NASDAQ. We got the E-mini. We got the gold prices here. I'll put the SPY up instead, but yeah. Yeah, at least most people know. No chance we cut rates today. No way. No, nah, pause. No. Yeah, nobody thinks we're going to cut rates. I think we cut. I wouldn't even be mad if we cut. Again, outside of having to only respond to the word dummy, I wouldn't even be mad if we cut. I think it's justifiable to cut right now, to be honest, right? The only reason the probabilities of us cutting today are even lower is because payroll showed up on Friday like 30, 40,000 stronger than expected. Payroll showed up at like almost 180K versus 130 something K expected. So payroll showed up like 40,000 more than expected on Friday, showing resilience in the labor market. And when you have resilience in the labor market, you have less of a need to cut. And that is probably why the percentages and the likelihood of a cut decreased so much over the last week. Prior to this past week, it was a like 10, 12, 13% chance likelihood that we were going to pause, or that we were going to cut, and today it's less than 1%. So so the actual press conference is going to be at 2:30. 2:30. The actual decision is going to be at 2 p.m. Eastern time. 2 p.m. It's a fun day, honestly. It's my favorite day that I run this live stream in. So, hey, y'all hit the subscribe button, hit the notification bell, hit the live button next to the play button. Make sure you're fully caught up. We got 45 minutes left until Big Papa comes out and speaks. Or no, I'm sorry. Big Papa comes out and speaks in about an hour and 15 minutes. But we're going to stream it all live here as we always do. If he cuts, we dump. Yeah, I think the problem with cutting rates right now, is that it's going to induce panic. If we cut rates right now, people are going to say, hey, why did we all of a sudden cut rates? Are bad things coming? And that's going to induce a panic. Also, this is all on the heels of CPI inflation data dropping live next Tuesday and Thursday. We got CPI on Tuesday next week and PPI on Thursday of next week. that all might influence the odds. Now, the Fed likes to look at PCE inflation, but yeah, that's what's going on right now. Gold, a pause, good or bad? I don't know. Gold typically is going to go up with economic weakness. And so pausing signals less economic weakness. I'm assuming it might make gold go down. But gold kind of moves in a macro way. It's not easy to predict. It can move with markets, or if we have like uncertainty, it can move against markets. So why panic? Well, I think it might. I don't know. Again, it's really nuanced, very subjective, very variance heavy is what I'll say in terms of like how a cut would impact the market direction. The reason I say panic is because it's wildly unexpected. And so if everybody thinks we're going to pause, like what's going to move the market the most is if everybody thinks one thing is going to happen and then we do something else, right? And so if everybody thinks we're going to pause and then the Fed cuts, that could induce panic. It could be a brash reaction just based off of nobody freaking expected it. Like we got baked into one outcome and then a different outcome happened. Again, I think it's pretty unlikely though, because Jerome Powell is usually very balanced and he doesn't want to like shock things. Like he doesn't want to jolt the system and freak people out. So I typically think he's going to do with what's expected. I think he might get some heat from the president though. I think the president is not going to like a pause today, but I think that's what we're going to do. And again, I'm not even saying I agree or disagree with any of it. I'm kind of neutral. I would honestly, to be completely real, I would rather us, I've said this once, I'll say it again. I would rather us go into a mini economic recession or depression versus inflation getting out of control again. My big fear is inflation. Prices have gone up 3, 4, 5x what they were. People are still living with those prices. You don't want inflation to spike again. And so one of the risks of lowering rates too early is it could exacerbate inflation and make the inflation situation worse, not better. And so I'm okay with pausing personally, but I know a lot of people are like, it depends on who they are. If you're a lender, you definitely want lower rates, you know. So it all depends. So what's the signs of QE? Whenever you hear the Fed talk about their balance sheet, they're referring to QE. It wasn't last meeting. It might have been the meeting before that, but we're still doing QT, which is the opposite of QE. So like the Fed is still restrictive in their balance sheet operations. They're still reducing their balance sheet. They did slow QT down though. I think it was the last meeting by 80%. So, you know, they reduced their treasury QT by 80% last meeting, but I think they kept mortgage-based QT the same. So they didn't change that, the volume of reduction of their balance sheet for MBSs. Which means that like mortgages, a little bit more hawkish for mortgages, right? But I think eventually, maybe today, maybe next meeting, they're going to announce an end to QT, which is a more dovish, less restrictive action. But we'll have to listen for that. If you want to know if they're going to do that or not, listen for influences to their balance sheet. You know, if they say they're reducing their balance sheet of MBS securities, or if they're reducing their balance sheet of treasury securities, that is QT. If they say they're slowing the reduction of their balance sheet, that is a more dovish thing. That means they're kind of getting rid of a more dovish action here. Why do people think this is my kitchen, bro? This is my library. Look. This is my library. I know everybody thinks I live in like my mom's basement, but this is my library over here, guys. You know. Hot Wheel prices have not changed, bro. Lego prices. I have an 11-year-old son. Lego prices. Crazy, honestly. What's your library full with? I would say it's a mix of like entrepreneurial and business books mixed with like historical books. Yeah. Thought you were in your closet? It'd be a nice closet. Definitely top 3 libraries. Just cooking up some facts, so easy to mistake it for a kitchen. Do you live in a mansion? I don't know if I call it a mansion. I mean, it's not small, but mansion, I don't know. No, I don't read all these for sure. These are all old. The CPI followed a pattern in the last 4 months, will come in around 1.8 to 2% next week. Yeah, CPI has been getting lower and lower and lower. Micro NASDAQ pullback. All right, chat. We got about 1,000 people here already. Still got 40 minutes left until the decision drops. 40 minutes. Yeah, I love books, man. I love reading. Top 3 best grandparents background of all time. Look, it's the same stream I'm in normally. Like, look. Look. Ready? Watch this. See, it's the normal background I always have. I just got a green screen in here. I'll leave it like this. I think this is a little bit better, but all right, guys, we got our timer right here. I'll put the timer up. If we pause, will the market go down? Pause is already baked in, so we don't really know how the market's going to respond. A pause is pretty freaking likely at this point in time. It's pretty improbable that we're going to do anything besides pause today. And so with that, we don't know if a pause is going to make the market go up or down. We don't know if the market's going to like a pause or dislike a pause. We really don't. We don't know if, again, it could go either way, to be completely honest. It depends on what the statement says as well, which we'll cover live here as we always do. But it depends on what the statement says. It depends on how the market is going to interpret a pause. The more important thing is going to be what Big Papa Jerome Powell says during the actual accompanying press conference. What Powell says during the press conference is going to be more important than the decision of a pause, which is almost certainly going to happen. Now, if we get anything outside of a pause, which is like if we get a surprise cut, which almost certain that we're not, if we get a surprise cut, that'll make chaotic movements in markets on either, I think, the downside, but it could go up as well. People might like economic stimulus. I think the market does want interest rate cuts. They just don't want to be surprised by it, if that makes sense. So again, I really don't know. I don't know what the market's going to give us here. We got to wait and see. We'll stick around. We'll cover all of it live. Would you personally buy gold? I like gold long term. Short term, I have no freaking idea what it's going to do. Gold's been uptrending for like 8 or 9 years now. So it's not my favorite time to buy gold, because if you buy gold now, you might get stuck in a long-term downtrend, which is an inevitability. Eventually it's going to happen. But with that said, gold is one of the single best inflation hedges over the last 20 years as well. So I think there's arguments for and against buying gold right now. Personally, we're a little too high for me to buy gold. But at the same time, I've been saying that since gold was at like 2,200. So I've missed out on huge gains in gold. So what do I know? Will Jerome Powell decide at 2 p.m. if we get to see John Jones versus Tom Aspinall? Maybe. Probably not. That'd be crazy if he did, though. All right, guys, let's get ready. Hey, the FOMC decision press conference. Stick around. We cover this live every single meeting. 30 minutes left. Over 30 minutes left. We got 35 minutes left here. Looking at our poll, 57% think he's going to be hawkish, 43% think he's going to be bearish. I think he's personally going to be hawkish as well. And the reason I think he's going to be hawkish is because we've seen signs of economic resilience, labor market resilience, high payrolls, high payrolls, lower jobless claims. We've seen signs, lower inflation. And so, I don't know. At the same time, we've seen lower inflation. But I think Powell is going to use the latest payroll report print as a justification to be hawkish. But if I really had to guess, I think he's going to be pretty sideways, neutral, data dependent. I think he's going to be apprehensive to make any bold prediction on what they're going to do or any bold guidance on what they're going to do moving forward. I think he's just going to be pretty sideways and neutral. Purple tie. It's almost certainly going to be purple. What's up, Faye? Mercy. It's at Beginner Trades. At Beginner Trades. Yeah, we did a poll. 54.5% are hawkish, 45.5% are dovish. Yeah, and look at that gold. Gold is so choppy right now. We honestly just made a bunch of money too, so we're up a little bit on the day. How much are we up? Let me see. Like, bro, I've been trading in the evening and just doing so well trading in the evening, bro. Yeah, we're up 150 bucks today. Somehow I've just done, like, I've done so much better in the evening than in the morning. I'm surprised at how well I do after the opening bell. Not right after the opening bell, but like at 11 or at 2 p.m., 3 p.m. I tend to do so much better for some reason. Yeah, I'm looking at gold. It's very sideways. Look at gold. Gold's right here. Chat, this is gold. Leading into the Fed meeting. And there is a strategy, like I've talked about this strategy a lot, where you just kind of attack choppy range sideways trends leading into big economic releases. Because typically ahead of big economic releases, sometimes ahead of big earnings, ahead of the FOMC meeting a lot of the time, what becomes the most predictable is a rangy market like this. Like, look at how rangy this market is. You know? Like, shorting the top of the range, covering at the bottom, buying the bottom of the range if you like, long covering at the top. It just becomes a lot more predictable in these moments. You got to wait for them, though, and that's the hard thing to do. Is Bitcoin going to go parallel as the SPY, which is the market? Sometimes it does. It depends on what it is. A lot of the time, Bitcoin will move in a macro way with markets, unless we have, like, bank weakness, which might be the opposite. So if, like, we got JP Morgan, Wells Fargo weakness, we might consequently get Bitcoin and other stuff straight because people hedge against that economic weakness with Bitcoin, or that bank weakness with Bitcoin. So we've seen different correlations, but in general, I would say it moves in a macro way with markets. Smaller correlation, but macro mostly. Pause on rates, somewhat dovish outlook, but expect another dump before the great reset. Market kicks in on June and July. Maybe. Kiera says all-time highs by June. 100%. Maybe. If I was back in London 20 years ago, I'd say yes, yes, for realsies. I don't even know English slang. I'm from Louisiana. So my slang, what did I say 20 years ago? That's tight. That's tight, you know. That's the tightest book over there, right there. That's a tight truck driving by. Yeah, that's tight. That's fresh. That's a fresh outfit you've got on. What else did I say? Bruh, a lot of bruhs. Hey, bruh. Come here, bruh. Oh, that's kind of an occasion thing. I'm from Baton Rouge. Go Tigers, you know. I'm sorry, my stream cut out for a second, so if it lagged, we're still here. I don't know what happened, but if the stream's cut out for a second, if it lagged, we're still here. Bruh is still heavily in use for sure, you know. Hey, we still got 1,200 people. Can y'all hear me? Are we good? No, we're still here. Yeah, the young people now use that brain rot. Yeah, it's stormy. Okay, good. As long as y'all can hear me, we're good. Hey, we got 30 minutes left until the Fed decision. 30 minutes left, chat. Be ready here. Stuff a little whippy. Yeah, we're good. All right, cool. Is that a good thing, Austin? I don't know, brother. I'm from Baton Rouge, Louisiana. Baton Rouge, Louisiana, actually a big movie or a big music hub, believe it or not. All right, so the Nasdaq started to turn a little bit here. Look at gold come down. Again, the Nasdaq at 19.9s, SPY at 561s. Thank you for doing the live. Hey, you're welcome, bro. We're here. Oh, well, thank you, Austin. New gold standard incoming. Is it really? Do y'all think the new gold standard is incoming? Maybe. All right, guys. We still got 30 minutes here until the FOMC decision. Lots of love from India. Thank you, Shub. Appreciate you, brother. We're good, CT. Thank you, man. I have 1,500 hoping for a 25 basis point cut. Yeah, I don't think you're going to get it, though, brother. AMD's coming back down. AMD is one of the big things that moved the markets recently. Like, here's AMD. 9860s for AMD. Yeah, I know. I'm from NBA, young boy. Yeah, I mean, I'm from Boosie and Webby. NBA. Baton Rouge is like an hour away from New Orleans. But yeah, gold now coming back up a little bit. Look at gold. It's fighting its way back up. Yeah, AMD. Gold's coming back up, guys. And again, we got the FOMC rate decision going live. 35 minutes. A little bit over 35 minutes. 25 minutes, I mean. Bought up Apple at 194. Yeah, the president has been pressuring Jerome Powell to cut interest rates. Let's talk about the biggest stories of today's FOMC meeting, though, chat. Let's talk about it. Make sure you hit the live button next to the play button. Make sure you're fully caught up on the stream. It's a big day. But again, rates are very probable at this point in time if we take a look at the likelihood of outcome here. Rates are very, very probable to stay at what we're currently at, which is 4.25% to 4.5%. Very probable to stay at 4.25%, 4.5%. Not very likely that we're going to change rates at all. Very probable that we're going to stay at 4.25%, 4.5%. 99 to 1% likelihood. 99 1% likelihood. Now, if we're talking about the biggest things to listen for in today's event, the Fed is not going to update its dot plot. So the Fed is not going to update its dot plot. The FOMC is leaving its policy rate unchanged, 4.5%. Again, there's not going to be any updated dot plot. So the dot plot with the updated economic stuff is going to be at quarterly, which is not today. Today's is not the quarterly one. His tie will be purple almost certainly. J Powell doesn't do Strimes. No, we're not delayed, Mahmood. We are on time. Hit the live button next to the play button. In every stream, there's about a 1 second delay, but we're not that. Like, we're not going to be delayed like that. Yeah, it's going to be a massive decision today by the Federal Reserve, but it's pretty probable we're going to pause rates and we're not going to move rates like that. We're not lagging, are we? Remember, the FOMC decision is going live very soon. Very soon. We got 25 minutes left total until the FOMC decision goes live. Okay, not lagging. All right, good. No one knows what they're talking about. Well, some people do. Some people understand. Like, you see a lot of streamers right now, and they're calling every rate decision a rate hike. A rate hike is a very specific thing. It means the Federal Reserve is raising interest rates. And, like, if you want to look at the correlation here to understand it, like, let's talk about it. So we can look at, like, CPI inflation and a graph behind CPI inflation here. Like, here's CPI inflation, right? Here is a federal funds graph, just to show you. right? So here's CPI inflation, and here's the Fed funds graph. And you'll notice a correlation between what the Federal Reserve does and inflation. And we talked about this earlier, but let's talk about it again. All right, so if you take a look here, here is CPI inflation graph. One thing that you'll notice is that the only time CPI and inflation literally go down is during really weak economics, like January 2009. Last time inflation literally went down and stayed down. Hey, thank you, due diligence. I appreciate you, brother. Thank you, sir. And then we got the Fed funds graph right here, right? So one thing that you'll see is that we had the economic weakness of 2020 that made prices actually go down or slow down to almost zero inflation. And but when the Fed started doing all this economic stimulus here, the consequence of all this stuff. So the Fed did all this economic stimulus here. Like, look, let me make sure you can see this. Yeah, so the Fed did all this economic stimulus here. This is where the Fed did all this economic stimulus. The consequence of this super low interest rate environment right here is this spike to inflation. So like the Federal Reserve doing all this economic stimulus, sending out stimulus checks, lowering interest rates to almost zero, doing quantitative easing and supply chain problems that happened in 2020. The side effect of all this stuff was this right here. This was the consequence of all of it. Inflation spiked. So inflation got really, really bad. And CPI inflation, you can see, got almost up to 10%. Got up to 9.1%. And again, this aspect, I've said this once during the stream, I'll say it again. This thing right here, this is why people are still unhappy modern age, is because of this inflation spike up to 9.1%. That is why people are still absolutely unhappy, is because inflation spiked up to almost 10%. Almost 10% inflation spike. So that is what we're still fighting back from. This is why a lot of people think the economy is weaker than it is. This is why a lot of people are unhappy now in modern age in terms of spending, is because prices are 3, 4, 5x what they once were. And obviously that's not good. That's not what people want. And so once inflation starts to spike like this, the Fed has to then pivot to a restrictive stance. And so this is the Fed being restrictive right here. This is them raising interest rates meeting by meeting all the way up to where we're at now, which is 4.25% to 4.5%. They raised them up to over 5%, and then late last year they cut them down to where we're at now, which is 4.25% and 4.5%. And then they paused them for the last few meetings since December. Really, they did a 50 base cut in September. In November, they did a 25 basis point cut, and then in December they did a 25 basis point cut, and that led us to where we're at now, which is 4.25%, 4.5%. And a lot of people are pressuring them to cut still, but you know, we'll see what happens. If the rate remains the same, does it buy or sell? I don't understand. Yeah, I mean, leaving the rates unchanged is already what's going to happen. So leaving rates unchanged is what's going to happen. So rates being paused or untouched is a neutral outcome. And when it's 99 to 1% likelihood, people that are investing and trading in the market, that is what they expect. That's kind of like the expected neutral outcome, is a pause, right? If we do something besides a pause, it's going to evoke panic and freakouts in markets. But as long as we pause like everybody thinks we will, then then we're probably not going to have too much volatility from this. Taking a look at bond yields as well. And bond yields are important to watch through all this stuff, because bond yields can have an influence on interest rates and vice versa. So like bond yields and interest rates tend to follow each other. And so here's the last 5 days where bond yields have spiked up starting in May, and then they've kind of fallen back down over the last day. Last 24 hours, bond yields have come back down. Now, again, remember, bond yields and interest rates follow each other. And so if bond yields go up, interest rates are going down, and vice versa. If bond yields are going up, that means we have a higher interest rate sentiment. If bond yields are going down, that means we have a lower interest rate sentiment. Bond prices and bond yields inverse each other. And so you can kind of see an example of this where here's the 10-year treasury yield symbol. You can see today bond yields are down a little bit. If we take a look at the actual bond prices, now it's a different time frame of bond prices, but if you look at TLT, which is actual bond prices, they are going up right now versus down. Bond yields are going down, bond prices are going up, and then interest rates and this right here follow each other. I know there's a lot of jargon, but if you understand these correlations, it becomes a lot easier to track this stuff. A lot easier to track. So I hope all this stuff makes sense. Powell speaks at 2:30 Eastern Standard Time. In about 20 minutes, we got the actual decision. And then at 2:30, we get the press conference. In theory, it's a perfect scenario to cut. I mean, the only thing that puts a hiccup in a cut push is payrolls came in higher than expected on Friday. Non-farm payrolls and unemployment. Unemployment was as expected. Payrolls were strong, showing a strong labor report. The strong labor report kind of puts a hiccup in a cut push because if the labor market is strong, you have less of a need to cut interest rates. And so that's kind of something that you want to understand with that. Like, that's what it is. Again, bond prices have been going up over the last 24 hours. Yields have been going down. And the labor market since last Friday, the labor market has shown resilience. And so in that regard, the Feds, again, to talk about this one more time, the likelihood of a cut was 10% before last Friday. Last Friday came out, much stronger labor market, showing less of a need to cut. And at this point in time, the likelihood of a cut is now dropped to 1% or less today. So, man, I think they're going to cut. I do not think they're going to cut. We'll see, but I do not think they're going to cut interest rates. Yeah, I like Bitcoin, and I think the closer Bitcoin gets to 100K, the more the momentum is going to show up for it, to be honest. So Bitcoin getting very close to 100,000. It's at 96 to 97,000 right now, depending on which platform you look at. It's getting really close to 100K. I think Bitcoin's probably going to push up more. Who freaking knows? But I think Bitcoin's probably going to start shooting up. Who knows? I don't know. Not an investment professional. Not liable if you lose money. Always make your own assessment. Not an investment professional. Not liable if you lose. Understand all the stuff on screen. Can't guarantee anything. Not an investment professional. Understand all the stuff on screen, guys. I can't guarantee anything, but yeah. Stick around. We're going to cover this meeting live as it happens. We got the FOMC decision today. So again, will the Fed hold its policy rate at 4.25% to 4.5%? Almost certainly yes today. Almost certainly yes. Traders are going to listen to any change in wording around progress towards the 2% inflation goal over time. Watch for phrases that signal whether the Fed views disinflation as on track or if it's still slow. They're not going to do a dot plot today. It only happens quarterly. We want to listen to the Q&A tone, his answers on stuff like tariffs. I'm listening for tariffs. The word tariffs, how they're going to impact the economy and rate decisions moving forward for the rest of this year. That's really one of the things that I'm incredibly likely to be on site for. Like if they say the word tariffs and how that might impact the market short term, how that might pop the market up, down, sideways. We'll see. We still got 15 minutes left until the actual decision, chat. 15 minutes left. If Jay Powell does cut, he'll say it wasn't influenced by anyone. Yeah, I mean, the president can pressure him to cut rates, but it's just not that easy. In the Federal Reserve's mind, like if we cut interest rates, we're contributing to potentially more inflation risks. You know, one thing they can do is they can slow quantitative tighten down to influence those markets. So one thing that I am going to also listen for is the reduction of the Fed's balance sheet. And if they're slowing that reduction down to zero, effectively meaning they're going to be ending quantitative tightening. Quantitative tightening is basically the Federal Reserve reducing liquidity, taking away liquidity from the bonds and financial markets. And so they do this by letting their current balance sheet run off and mature and not buying any more back. This keeps interest rates high, reduces liquidity in the economy, and ultimately keeps interest rates high. Now, they're still doing QT. At least they were during the last meeting. But it's still pretty questionable what they're going to do today, if they're going to end QT completely. And you want to listen for that tone in the balance sheet. Like, will the Fed reduce their balance sheet? Will the reduction in the Fed's balance sheet continue down? What that looks like, so forth and so on. So that's definitely a buzzword you want to pay attention to today, is what that looks like in terms of reduction of the Fed's balance sheet. See, the president's speaking right now, too. I don't make comments on administrative policy decisions. Yeah, I mean, I think he's going to be very hesitant to give any big guidance towards everything. I really do. I don't think he's going to be. John, I still don't believe you'll take Powell's job for free. Bro, if they gave me that job, I'd take it in a heartbeat for free. You know how you'll have a status in finance for the rest of your life if you're the Federal Reserve chairman. You'll make millions of dollars doing it regardless of what they pay you. You know, Powell's net worth is like 50 million or something crazy. Although he was that's a little bit different, but he was Powell was a investment banker prior to it, so that's what it is. Is it possible he hikes rates? Almost certainly not. Powell is almost certainly not going to be hiking interest rates today. Almost certainly not. You never freaking know, but almost certainly not. That's a very far unlikely decision by Jerome Powell. Incredibly unlikely that he hikes rates. Incredibly unlikely. But we'll see. You never freaking know. Again, the big decision is going to be at 2 p.m. Eastern Standard Time. We're going to stream it all live here as we do. So stick around. Hit the like button next to the play button. Hit the subscribe button. Hit the like button next to the play button. Yeah, Jerome Powell. We'll see what everything looks like here. You guys ready? Bond yields are still down. We got to put gold up. What kind of charts do y'all want up on? We can put gold. We can put Bitcoin. Bitcoin's pretty flat down the middle here. Yeah, I mean, he's almost certainly not going to hike rates. MicroStrategy. Yeah, I mean, Bitcoin's been running. SPY is still very choppy, very neutral, very flat, like very boring. So we're not really doing too much here, but yeah, the president's been speaking a lot, like a lot. Fed Chair John. Drop. Yeah. Okay, there's Bitcoin. We got gold up in the middle. We'll see what happens. Take out before the real move. 80% chance it remains the same. Yeah, we got over 10 minutes left still, chat. We got over 10 minutes left until the FOMC decision. And the decision is going to drop right at 2 p.m. Eastern Standard Time on the dot. So right at 2 p.m. Eastern Standard Time, they're going to cover the FOMC decision at an accompanying press conference at 2:30. And we're going to stream it all live here as we do. 80%. It's a way over 80%. It's like 99% chance that they do not influence rates. They don't raise rates. They don't lower rates. They pause rates. 90% chance likelihood of that. So it's pretty unlikely that we're gonna cut rates today. If they did anything outside of a pause, it would be a cut. But with the cut, there's only a 1% chance, like a literal 1% chance likelihood that they're gonna cut rates today. It's very, very low probability. Yeah, I'm showing 99 to 1. I think the most accurate one is probably like Polymarket is just like derivatives. But looking at the Fed Watch tool, again, here's the likelihood. Oh, this actually has changed a little bit. Hold on, let me refresh this. Okay, so this has actually changed a little bit. At this point, it is 98 to 2, basically likelihood of a pause, 98 to 2% chance. So at this point in time, it's very improbable that we are going to be doing anything besides a pause, but we still got a 2% chance, and 2% is 2%. I mean, this could, in theory, happen. It's pretty improbable that it's going to happen, but it could. You know, we'll have to wait and see. Yeah, highly unlikely. So you're telling me there's a chance. That's right. Hey, Dumb and Dumber joke. You're telling me there's a chance. Absolutely there's a chance. It's not a high probability of one, but there's a chance for sure. Again, hit the like button next to the play button. Bump those likes up. Let's see if we can get over 500 likes before 2 p.m. I appreciate it. Let's see if we can get it. 500 likes before 2 p.m. Subscribe, hit the notification bell. Let's keep the growth up. I have a feeling we may be surprised. Honestly, if we do a surprise cut, I will be the first to tell you I was wrong. You know, I will be absolutely the first to tell you I was wrong. I don't think it's going to happen, but it could. I mean, you never freaking know. And again, we're going to cover this live as it happens. Like, look, here's where the report's released. So the report's going to come out right here. Statement underneath these letters. Implementation note, statement, all that stuff. Look at the SPY come down here, chat. So the SPY is falling down fast. Falling down fast. But yeah, if we do anything besides what a pause, I will be shocked. Shocked. Surprise hike? Nah, there's no surprise hike. Hike ain't gonna happen. If a hike happened, the market would have so much red action show up. It would be crazy. A hike is not gonna happen. If a hike happened, everybody would freak out, like drastically freak out, you know. Yeah, so if a hike happened, everybody would panic and just freak out. All right, guys, we got 7 minutes left. 7 minutes. Still got time. Look at the SPY come down. SPY at 559s, almost under 560s. SPY hitting the bottom of the range. Look at Bitcoin come down too. So Bitcoin coming down. Gold is spiking up ahead of this report. Okay, so the president has said a couple things. All right, just to clarify the breaking news. He said to U.S. envoy to China says hello to Chinese President Xi. U.S. President says we'll take a look at exemptions, don't know on tariff exemptions. The Department of Justice and FTC seek info on unfair practices in live ticketing, according to Bloomberg. And U.S. President Trump says not open to pulling back 145% tariffs. So that is the news, the breaking news that's happened over the last couple minutes is that the president says he is not open to pulling back 145% tariffs. Not open to pulling back 145% tariffs. Again, stick around. We got 6 minutes left, chat. 6 minutes left. Listen to all this stuff on screen. I'm gonna make this in big yellow letters so people understand. The Fed decision is gonna be in 6 minutes, chat. 6 minutes. Again, bump that like button, hit the subscribe button. I appreciate it. So Lysandra, you probably got to refresh. We got about 320 something that I'm showing on my end right now. So you just got to refresh your screen, brother. Surprise hike would be hilarious. Honestly, if he surprise hikes, the market is going to super dump, right? If we cut, I don't know what the market's going to do. It's such a shocking thing based off of projections that if we cut, I think it might still make the market go down. But we could also have positive reaction for a cut because I think in the end the market wants a cut, and a cut means stimulation of the economy and potential upward movement in finance and stocks. So I think either one of them could happen. I don't think it's very probable that we are going to cut or pause. But hey, we'll see. Hey, thank you, Bulldog, my guy. Hey, what's up, brother? Appreciate it. Again, President Trump says he's not open to pulling back 145% tariffs. That news just came out. We got 5 minutes left. 5 minutes left. Give me your last minute predictions in chat. Hawk or dove? Hawk or dovish? What will Powell's tone be like, hawk or dovish? Markets are testing lows as the president said he's not willing to pull back 145% tariffs. President says he's not willing to pull back 145% tariffs. Market's dipping. Not dovish, hawkish, dovish, hawk. We'll see. Dude, my nose is so stopped up, dude. I can't even breathe out my nose. I've been sick for a week. Somebody said I smoked one. I definitely didn't. My nose is so stopped up right now. I've been sick for the last week straight. All right, guys, 4 minutes left. Hey, subscribe. Hit the notification bell. We got almost 3,000 people here already. We still got 4 minutes left. And then we got the press conference, too. Hawk 2. Is no cut dovish or hawkish? No cut is neutral right now. Altuve. No cut means neutral. It's what's expected. It's what's baked into the market right now. Is a zero cut outcome. What's baked into the market right now is a zero cut outcome. All right, 3 minutes left. 3 minutes. It's not allergies. I've been sick for the last week. I've had low-grade fever, stuffy nose, body aches, sore throat. All right, chat. It's time. I'm going to put Giant John up right now. Maybe I'll make myself a little bit smaller. Time for the FOMC decision today, chat. It's time for the FOMC decision. We got 3 minutes left. 3 minutes. Hit the live button next to the play button. Hey, make sure you're fully caught up on streaming. We got the accompanying press conference live here, 2:30. We're going to stream the entire thing live. Live here, 2:30. Yeah, it's a cold, most likely. You can see Bitcoin, chat. Bitcoin falling down for some reason over the last, maybe the tariff news on Bitcoin made it go down. But you can see Bitcoin coming down a little bit. Gold is the middle chart. We got the SPY up on the left. Gold up in the middle. I'm going to put the NASDAQ here. And then we'll put like, we got the NASDAQ. I'm going to put the NASDAQ in the middle. All right, chat, 2 minutes left. 2 minutes. Put the SPY up. All right, guys. You guys ready? Again, the president just said he's not open to pulling back 145% tariffs. Again, hit the sub button. Hit the notification bell. Let's get ready. We got a little bit over 1 minute left until the FOMC decision, and then the accompanying press conference is going to be at 2:30. All right, the accompanying press conference is going to be at 2:30 p.m. Eastern Standard Time. 2:30 p.m. Eastern Standard Time. We're going to stream the entire thing live. It is very probable, 99 to 1, 98 to 2% likelihood of a pause in interest rates by the Federal Reserve. If inflation's a risk, the Fed's not going to want to cut rates. If a recession, depression's a risk, the Fed's going to want to cut rates, hopefully, and save us from the upcoming recession or depression. 50 seconds left, chat. 50 seconds left. Hit the live button. Hit the play button. If you put it in 2x speed, it'll make sure you're fully caught up so you can actually watch the FOMC decision. But yeah. All right, again, we're going to read the entire statement live here as well. 20 seconds, chat, 20 seconds. I'm going to take this timer off. We're going to do a countdown. 18, 17, 16, 15, 14, 13, 12, 11, 10, 9, 8, 7, 6, 5, 4, 3, 2, and 1. Here's the decision. All right, the FOMC did a pause. They paused interest rates. The FOMC paused interest rates. We'll read the actual statement coming soon, but they paused rates. Market is kind of flat right now, but yeah, FOMC paused rates. Market hasn't really moved. As we told you guys, it probably wouldn't. But again, market paused interest rates, as we told you guys, would almost certainly happen. Fed has kept interest rate unchanged, 4.25 to 4.5%. We're going to read the decision pretty soon. Again, 4.25 to 4.5% is what the interest rate decision would be. And we're going to read the statement in a second, chat. Bear with me. I told you guys this is what we would get. I told you guys we were going to get a pause in interest rates. First move is the wrong move, maybe, but the market's not really reacting here. Again, if you're telling me I'm super late, you haven't hit the live button next to the play button. You know, again, rates were kept unchanged. 4.25%, 4.5% is what they showed up as. Yeah. And let's go ahead and read the statement. So, although swings in net exports have affected the data, recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level in recent months, and labor market conditions remain somewhat elevated. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook has increased further. The committee is attentive to the risks on both sides of its dual mandate and judges that the risks of higher unemployment and higher inflation have risen. In support of these goals, the committee decided to maintain the target range left unchanged at 4.25% to 4.5%. And considering the extent of timing of additional adjustments to the target range, the committee will carefully assess incoming data outlook. They will continue reducing its holdings of Treasury securities. So this is QT and agency debt and agency-backed mortgage security. So they haven't changed QT policy as well. They're still doing QT. They're keeping QT the same. And again, although swings in exports have affected the data, recent indicators suggest that the economic activity has continued to expand at a solid pace. The unemployment rate stabilized at a low level. Labor market remains solid. Inflation remains elevated. Committee seeks to achieve maximum employment, 2%. Again, they're keeping QT the same. You can read about this right here. The committee will carefully assess incoming data, the evolving outlook, and the balance of risks. They'll continue reducing the holding of Treasury securities and agency debt and agency MBSs. So again, they are keeping their QT the same here. And again, stick around. We are going to stream the entire FOMC decision live. Don't go anywhere. We are going to continue to stream the entire FOMC decision live as it happened. And again, so don't go anywhere. Again, we'll see what happens, chat. We're going to stream the whole thing live. Don't go anywhere. Stick around. We'll see if the market turns. But yeah, as of now, we came in. Pause. As we said, you guys cannot call me dummy now because, again, we came in as I told you we would. I told you guys we would come in here, and this is what we showed up as. And so, again, we're going to cover the press conference live in a couple minutes. So stick around. Don't go anywhere. Markets are very flat. Bitcoin honestly reacted pretty favorably to this. Again, Bitcoin honestly reacted pretty favorably. Again, I'm going to read the statement one more time. Although swings in net exports have affected the data, recent indicators suggest that economic activity has continued to expand at a solid pace. Basically, we're seeing a strong labor market and economy, is what he's saying right now. Basically, we're seeing a strong labor market and economy. Again, I'll put this up on screen. The unemployment rate is stabilized. Labor market conditions remain solid. Inflation remains elevated. This is a hawkish Powell, by the way, just to clarify. This is a hawkish Powell that thinks the economy is doing good, but inflation's a risk. This is a hawkish Powell. He did not reduce QT at all. He kept QT going the same. And yeah, stick around. But again, he did not end QT. He did not slow QT. He kept QT, which is a hawkish action by the Fed, the same. He thinks that unemployment and the labor market are solid, but inflation remains elevated. And because of that, they have paused interest rates, is what this basically says. He said they seek to achieve uncertainty about the economic outlook has increased further. Committee is attentive to these risks to both sides of its dual mandate. Dual mandate, guys, just to clarify, dual mandate means inflation fears. They want low inflation and a strong labor market. Okay, kind of the best of both worlds. Cake and eat it too, if you will. Low labor market, strong labor market with low inflation. All right, that's what the dual mandate is. They want strong labor market but low inflation. And so again, with all that said, the Fed has paused interest rates as we said they would. Now, attention now, chat. Let me make myself a little bit smaller. Put Giant John out the way. Attention now is going to focus strictly now on what Jerome Powell says during the actual FOMC decision. What Powell says during the actual FOMC decision is going to impact everything now. We also have the U.S. president coming out saying he's unwilling to lower tariffs to get China to the table. Unwilling to lower tariffs to get China to the table. Again, stick around. We're going to put a timer up now here, chat. So again, stick around. We're going to put a timer up now. Again, Fed holds rates. All right, so full press conference. Streamed live here, 2:30. Again, subscribe if you haven't yet. Hit the notification bell. Again, Powell is hawkish in the statement, by the way. All right, there we go. So we got the updates to everything right here. Look at the NASDAQ dump down here, Chad, on this China tariff news is most likely what's driving this down. Again, the NASDAQ is falling big on this China tariff news, in my opinion. Look at this. I think this is probably China tariff stuff. Go on. Probably. What do you guys think? China's President Xi says he's looking forward to talking ties and cooperation with President Putin. U.S. President Trump says he's unwilling to lower tariffs to get China to the table. And the NASDAQ and the S&P have both dropped drastically in a late reaction here to the FOMC press conference. This is going to be in about 23 minutes. Chat, 23 minutes. We're going to stream this all live here as we always do. 23 minutes. We got about 22 and a half minutes, really. What? Yeah. All right, so we got a timer right here, chat. We got a timer right here. Make sure you guys can see it. Again, this is probably the news that's lowering the market right now, making the market drop. Again, Powell was hawkish, in my opinion, so less pushy of rate cuts, more worried about inflation. And again, let's talk about it. Powell, just to clarify, said the unemployment rate stabilized, labor market conditions are solid, inflation remains elevated, is what Powell said. He said basically he thinks the economy's doing good. Inflation's a risk. The labor market is strong. And the Federal Reserve is only going to cut interest rates if we have a weakening labor market, a weakening economy, and inflation under control. So again, this is very much a hawkish Powell amid the president of the U.S. talking about tariffs tanking the market on the way down here. Yeah, again, this is tanking the market down. The question is this what's impacting the market? Stick around, guys. Stick around. We are going to cover everything live like we always do. But I'm pretty sure the tariff news is what's tanking the market, right? Y'all can correct me if I'm wrong, but I'm pretty sure that's what this is. China President Xi says he's looking forward to talking ties and cooperation with the Russian president. The U.S. president says they're unwilling to lower tariffs to get China to the table. He also said that he's not open to pulling back 145% tariffs. And so some less optimistic, more pessimistic news regarding the economy after the interest rates were left unchanged, paused at 4.25% to 4.5%. And now we have the accompanying press conference in 20 minutes, chat. 20 minutes here. I'm going to end this poll. Or actually, we'll leave the poll up because it has to do with Powell. China's meeting with Besant on Saturday. Yeah, for sure. Yeah, maybe it could be the China-Russia news for sure. If that's true, why did Powell cut rates last year with a booming economy? I don't know. Powell had paused rates for a year straight prior to cutting rates late last year. And so again, that's could have something to do with it. Again, Powell had Powell paused rates. Looking at the federal funds graph here, chat. Like, look. If we look at a Fed funds graph, so this is the Fed's interest rates over time. If we look at the last 10 years, starting late last year in September, Powell paused rates from about 2023 to 2025 almost to late 2024. Cut rates about a full percentage point late last year from September to December, and then paused rates since then. That has been the Fed's decision. And so this will be a continuation of the same trend, which is a pause. It's looking most likely like we're going to pause rates. Taking a look at next month here, the likelihood of a pause next month is, let's take a look. So here's the CLB watch tool. The likelihood of a pause in June is still very low. Let's refresh this just to make sure. Okay, so the likelihood of a June pause is currently still at 71.5%. Now, we do have a 30% roughly chance of a cut in June. So it is possible that we have a cut in June. Very possible. And yeah, I think what Sam might have said makes sense. So the China-Russia cooperation news could be what's tanking the market. So we got news about 5 minutes ago that China President Xi says he's looking forward to talking ties in cooperation with Putin, the Russian president. So China and Russia working together is the news that came out 5 minutes ago. That probably is tanking markets, chat. Probably tanking markets. Again, we are going to stream the entire press conference live right here. Stick around. Don't go anywhere. We got 15 minutes left. Oh, can you guys see this? Let me make sure. Okay, yeah. So look. Basically, let's explain the graph again. 2020, lockdowns, drama. Federal Reserve brought interest rates down to almost zero. After that, they kept them there. They did a bunch of QE as well. All this stuff contributed to high inflation. By 2022, inflation spiked. The Federal Reserve then pivots to raising interest rates to try to push inflation back down, pushing the economy down with it. And then they paused rates in in 2023 all the way up until late 2024. And then they cut rates a full percentage point the last 3 months of last year, and then they paused rates for this year so far. They've paused rates twice, and then really 3 times, including today. So that is the Federal Reserve. Again, this big rate hike cycle by the Fed was to push inflation down, and inflation did slow down here. Again, if we look at CPI inflation over time, the Federal Reserve being really like restrictive, which is this big upward angle here, this big upward move, which is rate hikes by the Federal Reserve. This did help inflation. Like, look how much inflation went down. Let me put this up. So like look how much inflation went down once the Fed started being restrictive. It was almost a 10% CPI, came all the way back down to currently it's at like 2.4% CPI inflation. And CPI inflation drops next week as well. Next week is where we get CPI inflation coming out. So it's all relevant. We'll see what happens. Bond yields. Let's take a look at bond yields now. Let's take a look at gold as well. Bitcoin kind of following markets. Gold, rip it up. Gold is only about $100 an ounce away from all-time highs as well. Interesting, though, Treasury yields decreasing on this Fed decision. Treasury yields coming down, which shows a lower interest rate sentiment. Interesting. Hey, we got 15 minutes left until the FOMC decision, Chad. 15 minutes left. Let's do this. Again, basically, Powell said, I'm going to review it again. Powell basically said, that the labor market was strong and resilient. Inflation was a risk. Sorry. So again, Powell basically said the labor market was strong and resilient. And I'm going to zoom in here so we can make sure to catch this full press conference. I'll get myself out the way. I'll watch some markets leading into this. Get lower. We got the SPY and gold right here on these charts. SPY and gold. There we go. Ready for the Fed decision here, guys. Robinhood putting out some news that said they plan to blockchain to trade U.S. assets in Europe. 15 minutes left, chat. 15 minutes left. Let me do this a little bit better here. There we go. There we go. We got gold here on the left. We've got the SPY up on the right, or on the top. We're ready. Stick around. The other big news today, again, guys, the big news today, if you want to be honest, is the Federal Reserve not ending QT, right? So quantitative tightening is a restrictive monetary policy. It is a policy in which the Federal Reserve unloads its balance sheet, reduces liquidity from its balance sheet in order to combat inflation. The last meeting, I think it was either the last meeting or the weekend before, the Federal Reserve slowed down their QT by 80%. They didn't effectively end it, but they slowed their Treasury quantitative tightening by 80%. They reduced the cap on Treasury holdings by 80%. They kept MBS QT, the reduction of MBS securities, the same, which is worse for mortgage rates. A more hawkish stance for mortgage rates. And so a lot of people today thought that they would be ending QT completely now, which is kind of like a dovish thing, a stimulus thing. Like ending QT is stimulating the economy because it's reducing the liquidity that's getting taken away by the Federal Reserve's balance sheet, if that makes sense. And so a lot of people thought they would end quantitative tightening today, which is, again, a more dovish thing. Instead, if we read this report here, I'm going to have to make it real small. If we read this report, the committee will continue reducing its holdings of Treasury securities and agency debt and agency MBS. So they're keeping their MBS reductions QT the same. They're not ending QT at all. They're not reducing MBS QT, mortgage QT. And they're basically saying their dual mandate, 2% inflation and strong labor market, maximize employment and 2% objective. If you hear dual mandate again, it means they want low inflation and strong labor market. Is basically what it means. But I don't have more context on it. Again, China's president, Xi, says he's looking forward to talking ties in cooperation with President Putin. That's all he said. And then we had the U.S. president say he's unwilling to lower tariffs to China, to get China to the table, basically. So that's all the context I have. That's probably what negatively impacted markets. Again, look at gold here. Gold's coming down. Why what? The Fed has bought a massive amount of 10 trillion bonds the past 2 days. I think QT will end when the debt ceiling is increased because someone has to buy those bonds. Yeah, maybe. Yeah, QT will probably end when they start cutting. That makes sense. That's probably true. I don't know. I'm just looking at news releases. Robinhood said to plan blockchain to trade U.S. assets in Europe. And again, we do currently have Treasury yields decreasing here. Treasury yields coming down. Here's Treasury yields. They have decreased from this report, although they did pop right back up. But Treasury yields currently at 4.26%. And remember, guys, yields and interest rates follow each other. And so if we have lower yields, that typically means lower interest rate sentiment, especially with like mortgages. So interesting how yields are coming down on MBS QT staying the same. I would think people would expect to end QT, especially with the reduction of it last time, but maybe they're going to reduce it by 80%, wait a couple meetings, and then end it, I guess, is their plan. That's what seems to be the most logical plan. So we'll see. Again, hit that subscribe button, hit the notification bell. I appreciate the love. Thanks so much, chat. We're going to keep things going here, chat. FOMC meeting going live in about 10 minutes. 9 minutes, really. Yeah, so again, we got FOMC stream live. Look at the SPY come back. So the SPY dipped initially after this Russia-China news. and the president unwilling to lower tariffs, they kind of happen simultaneously. They happen within 3 minutes of each other. And so it's, we're trying to figure out which one caused this big market reaction. We don't know yet. But the market's kind of bouncing back. Gold is coming back down a little bit. So you can kind of see how there's inversing here where gold goes down, market goes up, and vice versa. 9 minutes left. I would say the press conference, King, is more important than the decision. The statement's important, but I would say this press conference is more important than the actual decision, in all honesty. This press conference is going to indicate what the plan is. I think Powell's going to be very data dependent, very flat, very unwilling to give guidance, is what I personally think. But who knows? You never know. It could go the other way. Maybe Powell starts to give guidance. You really don't know, right? But I tend to think Powell's going to be very reluctant to give guidance, very flat, very neutral, very apprehensive to make any bold stance on anything and commit to anything is what I think. And so I think Powell's going to be very apprehensive to make any commitment to stance or anything like that. So that's what I think. And again, we'll see. We'll see. The decision is now live, and now we got the actual press conference. We got 8 minutes left. 8 minutes. And again, if you haven't already, hit the subscribe button. Hit the notification bell. We appreciate the love. Thanks so much. Again, and I we had a lot of people betting on a cut today. I told you guys, man. I'm not sure. They say Einstein's definition of insanity is continuously trying the same thing, expecting a different result. Some people, it's all good. But some people, every single FOMC decision, they bet the most improbable outcome. And then they're shocked when the 99-1 option happens, chat. And so I hope you guys can really learn from this. Look, if the CME watch tool says there's a 98-2 or 99-1% likelihood of a Fed decision, you might not want to bet on the 1 or 2%. I'm not saying it's dumb, but it definitely ain't smart. That's all I'm saying. All right. I hope you guys understand. It's all love here, but smarten up. You can watch all these different sources and on the outcome of today. You can watch all these different sources on what the decision is going to be, especially. Now, you never know what Powell's going to say. You don't know if Powell's going to say good, bad things about the economy. You don't know. And I think some of you guys are watching financial media outlets that are just trying to get your attention. And so they're telling you that we're going to cut so that you pay attention to them, right? Sometimes the reality is more boring than that. And I hope you guys can see that manipulation there and just understand it's pretty freaking improbable that we're going to do something that's only a 1% chance likelihood by analysts, and especially by the CME watch tool. If you look at the CME watch tool and it tells you there's 99-1 or 98-2, you better believe that's what's probably going to happen here. Again, leading up to this report is 99-1. And again, now, just to clarify, this is if you look at it 15 to 30 minutes prior to the decision. It could always fluctuate for a week, a week out, 2 weeks out, 3 weeks out, a month out, because economic data can come out like high inflation making a cut less likely, low inflation making a cut more likely, so forth and so on, right? So we can have economic reports that influence these percentages, but if you look at this the same day, it hasn't been wrong in years and years since I've started covering these FOMC decisions. It just hasn't been wrong, and so I get it. It might be fun to be contrarian, but you also have to understand the probabilities behind stuff like this. You really got to understand the probabilities here. And in this situation, the probabilities were not on the cut side. So I hope that makes sense. Yeah, I made a bet with them that they could call me dummy if we cut today for a week straight. And I very confidently made that bet because only somebody that doesn't understand finance is going to make a bet with me on that against me. So Jay Powell was heavily criticized by the media in his last speech for commenting too much on government policy as tariffs. As such, he may tread a little bit more carefully. Yeah, I think he's going to be really apprehensive to make any big guidance or prediction or guide towards what they're going to do. I think he's going to be incredibly data dependent, incredibly neutral on things. Almost certainly. He's going to be neutral and very sideways. All right, so we're going to turn this music off. I'm going to make sure, I pride myself on having the loudest Powell stream in the book. So we're going to make sure we're super loud right now, waiting for this conference to start. I'm going to mute the background music. And, yeah, we should be pretty good here. So bear with me. All right, so we're still waiting for this report. And we're going to get a couple different sources to make sure like we're really on it in terms of like reaction time. And make sure we got like the most up-to-date one here. So stick around. Again, hit the live button next to the play button. Make sure you're fully caught up on stream. If you hit the live button, you can also put it in 2x speed. And he's not going to talk fast as long as you're up to date. Make sure you hit the live button next to the play button before it starts. And you can also put it in 2x speed. It's kind of like a cheat to always keep it up to date with the least amount of latency possible. And so again, hit the live button next to the play button. Put it in 2x speed, and it will always stay up to date with the least amount of latency here as well, chat. So we're still just kind of sitting here waiting for them to speak. I'm going to refresh this. We're just kind of waiting for them to start. Nothing yet. All right, 1.5 minutes, 1.5 minutes. Let's get ready. 1.5 minutes left. We're going to do a countdown as well. 1:20. All right, here we go. Ooh, do they have it starting right at the music ending? Again, as soon as it starts, let me know if the sound is good. We should be pretty freaking on point with the sound, though. All right, still waiting here. Less than a minute, chat. Less than a minute. We got about 50 seconds. 50 seconds. $50 seconds. 40 seconds. All right, so I'm trying to gauge which one's coming in sooner. All right, so here is 20 seconds, 15 seconds. The timer's a little bit early, so we're going to cut out. Again, 10 seconds, just about 10. 9, 8, 7, 6, 5, 4. Okay. This one's better. Waiting. Here he comes. Purple tie. Purple tie.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think, if you look where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timrose, the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
John L.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times, but the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now, and we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension, so let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. You know, we haven't faced that question in a very long time, so again, difficult judgment to make, and not one that we face today, and we may never face it, but you know, we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned, and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also, there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that. But in the meantime, yes, we're watching it extremely carefully, like everyone is, but don't see really much evidence of it in actual economic data yet. And by the way, consumers keep spending, credit card spending. It's it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. Look, I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we, of course, tapered and everything. And then we immediately went into QT, and, we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential. And we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not in your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses, big and small, are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, so we really don't see in the data yet big economic effects. We see sentiment, their concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen. 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. We don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we have the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the two goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far one variable is very, very far from its goal, much farther than the other, and if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. You know, I think you know what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, you know, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. You know, I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
You know, we don't give Congress fiscal advice. They're going to do. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path, and it's on Congress to figure out how to get us back on a sustainable path, and it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risk to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad, and again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic-era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decisions. So the volume of the imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of the first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories government or inventories government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is, we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right, though. We had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data. And we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night, and this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy. When it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
All right, guys, so that is the end of today's FOMC. The SPY is basically right where it was as the press conference started, honestly. We did the pause decision, and I'm just going to say it's pretty predictable here. I told people leading up to this report, Powell's going to be data dependent. He's going to be apprehensive to give guidance. Pretty predictable, I think, and that's exactly what he was. Let me know right now. We did a poll recently. Are you optimistic after today's FOMC meeting? Let me know. Let me know if you're optimistic after today's FOMC meeting. Before you guys go, we day trade live every single morning right here on YouTube. We don't sell a course. We don't sell a service. We don't claim to be experts. So hit the subscribe button. Hit the notification bell. You can check out one of our sponsors. And honestly, we had a pretty good day. Total, we're up a couple $100 today. Trading these ranges. Look at these ranges in the futures market. Let me zoom out a little bit. Look at these ranges. We are trading on what's called Top Steps Funded Account Program. If you want to learn to day trade, which can be very profitable, it can really be a skill you have for the rest of your life. If you want to learn to day trade, do not risk your own money trying to day trade stocks or, futures. It just makes no sense to. Instead, try a funded account program. Top Step is one of the most legit in the world. And it's just a beautiful way to learn when most day traders lose money. And so Top Step gives you a 50K demo. They test your skill with it. If you pass the test, they fund you 50K up to 150K, depending on which package you choose, with a 90% split. And they've paid out hundreds of millions of dollars to their traders. If you fail, the base one's $50. And learning how to trade with some risk, but not the fullest extent of potentially losing thousands and thousands of dollars funding your own account, is a huge edge when you're learning how to day trade. Almost all day traders lose their first year. You can try this out, and if you do lose, which is pretty probable regardless of where you go, it's going to be most of the time a lot less than you would funding your own account 5, 10, 20, 30 grand and losing that. In the futures market, you could day trade the S&P, the NASDAQ, the Dow, the Russell, gold, some currencies. Patterns are incredibly similar to day trading patterns that you would get day trading stocks. No PDT rule, and it just makes sense to learn this way. Similar reward to funding your own account as well. You get to keep 90% once you're funded, and then before that split kicks in, you get to keep your first 10K. Very similar to funding your own account. The risk is much less most of the time, with $50 a month for the base one. And again, the futures market has better liquidity. It's actually where most pro day traders go, is the futures market. Top Step's one of the most legit one in the world. If you use my link and go to Top Step X, you get 0 commissions and tiny amount of fees per trade. 0 commissions, tiny amount of fees per trade. I'll put the link up right there. I'll pin this to the top of the chat. And we'll see if we can get some trades in here. I kind of want to buy this dip, but I really don't know what the market's going to do. Really data dependent. We'll see. I'll show you guys what day trading futures is like. So we're up here. We got the top of this range. We're above the 200 EMA. I'm worried we're going to start slumping down, but you know what? We'll try to buy this down here. All right, we got one contract in. There we go. Nice. We might add to this. We got a small gain on this trade. We'll see if we continue. And again, you can kind of see how it is. We'll buy down to 850 right here. If it breaks under 850, we'll cut it. All right, we're going to go and buy that there. See if we bounce right off of 850s. We're flat right now. Let's see if we get that 850 bounce. Again, this is very similar to day trading stocks. Like, it took me a long time to go to futures, but I should have gone a long time ago. When I first got started, I lost like 4,000 or 5,000 in the beginning. And again, if you want to check out the link, here's the link right here. Great way to help support the channel. We'll let the 200 exponential play out. I understand all this stuff on screen. I'm not an investment professional, not liable if you lose money. Always make your own assessment, trade responsibly. I'm top 3 most biased trader of all time ever in the world. Understand all this stuff on screen. We're kind of flat on this position here. Let's see if we can buy more. We got a little pop back up. Let's get a little bit more. All right, we'll take half off 8 there. And then we might have lost a little bit. We'll actually add back into this. Now we're starting to break down. I want to see if we bounce and retrace off of this level. We're right at the 200 EMA. A lot of the time we bounce at the 200 EMA. So I got a little time. Let's see if the retracement up continues. Flat so far on the trade. So how you guys doing today? You guys red or green today? Red or green? That's better. All right, we cut half of that. Lock that in. We're going to go to get out right there. So we just made 20, 30 bucks from that trade. Very small, but you can see how similar it is to day trading stocks. We'll see if we get another dip buy. I'll buy a dip again. I need to take a little bit larger size here. But again, you guys red or green today? Somebody said green. Y'all want some music? I got you. Hold on. We're getting that dip again. All right, we're going to buy this right here. See if we get another little pop back up. We got a good enough cushion on the day where it doesn't matter too much. I got to lower the volume of this, though, because we had Powell turned up. So, let's see. Hey, we're going to take another piece off, half off, lock that in. You can hold the rest pretty break even on this, too. I want to give it time to run. There we go. Do I want to add to this? It's really struggling to hold over this level, though, the 200 exponential. So I'll give it one more second. We're completely flat. We're green on the trade right now. But if it breaks 2 down underneath it, we'll get out for a small win. Looks like it wants to come back up, but... All right, we're going to go ahead and cut that. All right, so we made money on the trade. Sing to us? Y'all got to pay more for John's, this voice of an angel right here, bro. Y'all going to have to pay more for that. Again, Powell's done. Again, hawkish tone for Powell, basically. Really hawkish tone, in my opinion. All right, so now we're breaking underneath these levels. We will pivot to a short-based strategy, too. So let's see if we can pivot back up, and we will short this. All right, so we jumped in short at the 200 EMA. As long as we don't get, like, a huge retracement, we should be all right. That's a big retracement. Let's see if we can add one to this here. We got 2 contracts. There we go. There we go. We took another piece off there. Hey. Not a bad little breakdown. I'm going to add to this here since we're already so green. We're starting to turn deep too. We'll take that off. Close to the bottom. Hey. All right, we'll add a little bit more to this. We'll add a little piece to this too if we bounce back up. There we go. Come on. All right, we took half off. We got 1 contract left. Very small. We're up 250 or so on the day. And we're out. Beautiful short here, attacking this breakdown. Once we started breaking under 835s, that's the level we want to attack. And so again, at this point today, what are we up right now? We are about $300 today. A lovely day. We'll take it. Again, if you want to watch me trade live every weekday morning, I'm the top 3 worst trader ever in the world right now. Definitely top 3 worst ever. But if you want to watch the worst ever trade, subscribe, hit the notification bell, hit the live button. Let's see if we bounce here at 8. I got a level at 8. I almost want to buy it. But look, there's the 8 test. Bounced right there. Definitely top 3 singers ever. So what you guys doing for the rest of the day? We got some earnings. Do we have any earnings after the closing bell today? Let me see. What do we got? All right, look, now we're under 8s. Look at this. We got Carvana, AppLovin, ARM, AMC all after the close. I'm not really going to cover this. It's not really my style. And then you give me a follow at Beginner Trades on x.com. If you haven't followed me there, give me a follow at Beginner Trades. We cover all this breaking news stuff here as we do. Here's the link if you want to check it out. Really, it's x.com. Give your boy a follow. Look at the NASDAQ turning here, chat. There's the at Beginner Trades. White House CEA chairman says the U.S. has the leverage in the China dealings. Look at the NASDAQ turning here on the downside. Definitely red. Yeah, I'm just going to wait. I did a poll here. I asked people, are you optimistic after today's FOMC meeting? We got about 700 votes. 55% say no. 45% say yes. I guess that's not like a big shock. Man, this is like, what kind of music is this right here? I was kind of digging it for a second. I still don't know what kind of music I'm on. Did we get a bunch of subs today? We did. Hey, appreciate the love, guys. Thanks so much. We got jobless claims unemployment filings next week. Jobless claims unemployment next week. Be ready. Or no, tomorrow. I mean, we got jobless claims unemployment tomorrow. Yeah, it was fun watching Powell. All right, I'm going to cut out of here, guys. But again, if you want to check out Top Step, great way to help support the channel. Most day traders lose. We're up hundreds on the day right now trading futures. I'm trading the QQQ price action in futures. No PDT rule. Just a beautiful way to learn when most day traders lose money. It's just a good way. Like, most day traders lose, and that's probably the same here. Most day traders are going to lose. But frankly, it's a lot cheaper to lose and learn on here than it is to fund your own account 5, 10, 20, 30 grand and lose that. Like, this is objectively true in my opinion. You know, I mean, opinion is kind of not objective, but objectively true in most people's minds. It's going to be a lot cheaper to lose there versus funding your own account thousands of dollars. And again, they give you a 50K demo. That teaches you how to trade better. You learn how to follow rules in a structured environment. And if you fail, it's not the end of the world versus funding your own account thousands of dollars and probably losing it. So again, if you want to check them out, again, they give you a 50K demo. You got to make 3K in profit on that demo without losing 2K. First, following their rules and conditions, if you can do that successfully, they fund you 50K, 90% split. You get to keep your first 10K in profit. If you fail, you're up $50 for the base one, $100 for the middle one, $150 for the top one. It teaches you how to trade better, and their new dashboard's really nice. Very similar to day trading stocks too. All right, so I'm going to get my stream for tomorrow ready. Tomorrow we got jobless claims, unemployment filings, 8:30 Eastern Standard Time. All right, so we got some breakdowns here. All right, so let's see if we hold under $800. Yeah, so we got weekly unemployment reading tomorrow, 8:30 Eastern Standard Time. All right, guys, I'm going to cut out of here. Hey, I love you all. Y'all have a great day. Be safe in the market, guys. Again, if you want to check out Top Step, I'll put the link up one more time if you want to check them out. There's the link right there. You can also see it pinned at the top of the page as well as in the chat. Thanks for all you do for us. In all seriousness, bro, you're the realest. Hey, thanks so much, man. I appreciate it. We try to cover free market news and free data. Feels good, man. Feels good. I appreciate the love. Thanks so much. Y'all have a great day. Hey, be safe in markets tomorrow, 8:30 Eastern Standard Time. Be ready. Love to all you guys. Appreciate the love. And have a great day.